I have a few videos out there talking about day trading and more often than not, high frequency trading. You can check out those additional videos if you follow these three links here. Today, I want to talk about whether or not high frequency trading has a positive or a negative effect on capital markets. So on the positive side, the answer, of course, is that high frequency traders are providing liquidity. So that makes it easier to trade. There's more liquidity out there. There's always a buyer or seller if you are in need of one. And it's cheaper because the bid-ask spreads are narrow. So it's cheaper for market participants. So this is a good thing. Also on the good side is that because there are more participants, more liquidity, more volume, that we get more price discovery. We're faster to converge on the correct price because of all of this extra liquidity and volume. Also, on the good thing that I hear is, hey, just bring competition to the market. But ultimately, this argument provides the same answers as the previous two. It's largely the same thing here, that this competition provides price discovery and liquidity. Now, of course, on the bad side of things, of course, in terms of criticisms, is that high frequency traders are essentially like super speculators, right? They're acting on order flow. They're using algorithms to determine whether or not the order flow is going to drive prices up or down, and they're acting on that to kind of prey on other investors, right? They're not using fundamentals to determine how prices are going to change. And ultimately, this order flow, timing, and algorithmic trading is a zero-sum game. So they're actually transferring wealth from investors to themselves. They're not really adding anything to the market. Another criticism is that this competition, this liquidity, this price discovery, this is really kind of bogus. It's just pretend. It isn't really there, right? These holding periods of high frequency traders are very, very, very small. A lot of these trades, a lot of this liquidity and volume is happening between high frequency traders. This is called ghost liquidity. It appears that it's there, but for actual investors, it's not really there more than it would be if high frequency traders were not there in play. Another on the bad is back to competition. So a lot of people say this is a good thing, but it looks like because of the speeds involved, these connections between markets that we've talked about in previous videos, that ultimately it's the big players that have this unfair advantage. So the competition really isn't there. It's only given to these profits are only given to the big players. So it's actually a detriment to competition. Another criticism is that these high frequency traders actually cause market instability or worse, right? So volatility goes up with high frequency trading. Crashes and flash crashes that we've seen in the past are all a result of high frequency trading. And of course, there are players in that market who have been found guilty of doing things illegal like spoofing and layering. So another criticism there. Now, if you look at academia, kind of the general consensus is that on balance, high frequency trading is bad for markets. And I think in general, what we'll find is that the people who are profiting from high frequency trading will say that they're providing a service for the market and deserve to be compensated for that. And those who are not high frequency traders are saying, look, net is really not really doing anything for the market. They are just chipping away at some of our profits and transferring that wealth to them. Anyway, curious what you think. Happy trading out there.